السلام عليكم ورحمة الله وبركاته. اخواني الحضور، شرفنا حضوركم اليوم واخواتي بعد، وان شاء الله دأب الجمعية الاقتصادية على تغطية احداث اللي تهم الاقتصاد الكويتي بشكل عام، وبالتحديد اليوم حبينا نغطي موضوع مهم اللي هو يغطي القطاع من القطاعات المهمة والقطاع المصرفي في الكويت. وراح يكون محاضرنا اليوم مستر راغو، وهو النائب الأول رئيس قسم الدراسات والبحوث في شركة المركز المالي الكويتي. ومستر راغو خبرة مصرفية وخبرة استثمارية عريقة 25 سنة، مينلي في قسم إدارة الثروات، وهو حاصل على شهادة CFA وعضو معهد CFA في الولايات المتحدة. بلجر having here Mr. راغو.
Thank you very much. Assalamu alaikum. I hope you can hear me, right? Today evening, I'm going to be specifically focusing on a very important topic, which may have a lot of economic implications for the Kuwait, which is Basel3 and how it can impact the Kuwaiti banks. Before I move on to Basel3, I thought I will give you a very bird's eye view about how the Kuwait banking industry is structured. How does it look, the big picture for Kuwait banks? As you can see here, a very usual comparison is to the GDP. Normally this is a good proxy to see how big the industry is, so that we can know whatever happens to that sector has implications for the overall economy. So when I look at it from a GDP perspective, you can see that it is nearly on an average during the last so many years, it's as big as the GDP. It's nearly in some years it's even 150% of the GDP. Currently it's about 132% of the GDP, which means that it is significantly a large sector to analyze and worry about. And from a profitability point of view, it is the largest sector in the stock market. Measured from a market cap point of view, it is more than 50% of the stock market. And even from a profitability point of view, as you can see here, it contributes significantly to the overall profits of Kuwait, which makes it a very important sector to look at. The way Kuwait banks affect the economy is through lending, and it is interesting to see where they lend and what is the sector in which they have concentration. Here is the statistics that runs very deep all the way up to 2003. You can see that the major areas of lending happens to be trade, non-banking financial institutions, which includes investment companies and financial services companies. You can see real estate and construction, and then you have personal loans, which is further classified into consumer loans and installment loans and security loans. So you can see that as of 2013, the bulk of the lending happens to the personal loan segment, which is about close to 40%, followed by real estate at about 33%, and then you have trade, which is very insignificant at just 9.5%, and that's been the historical trend. So there is nothing very significantly different that has happened in 2013. But this has been the general pattern for the Kuwaiti banks' lending habit. They have been, at one point of time, they have had some exposure which can be considered a bit significant to investment companies, but today at about 5.6% is well contained from a risk point of view. This is how the players stack up. We haven't looked at foreign banks, which normally has a one-branch license in Kuwait, and we haven't looked at other GCC banks that have recently opened branches in Kuwait. But these are Kuwaiti banks, and we can see that National Bank of Kuwait being the largest with about $75 billion of assets and $65 billion of deposits, and it leads the pack in terms of its size, followed by Kuwait Finance House, and the list goes down all the way up to Warba Bank, which is 1.7 billion. So there is a lot of skew in the banking among banks. Some are too big, and some are too small. So this might also have implications as we study the problem. Now, since this is just a quick bird's eye view about the sector, I thought I'd just sensitize the audience with the big picture before I dwell deeper into Basel3 as a subject. Now, what is Basel3? Throughout this presentation, I'll be using many banking terms, and I thought it would be good to briefly explain what they mean, so that you're with me when I go through the issues. Now, Basel3 is basically a banking regulatory standard that is being developed. Primarily, it is in response to the global financial crisis that happened in 2008. As you all know, what happened to the banking, the financial sector per se, as a consequence of the bubble and the bust that happened in 2008, and Basel3 is a direct response to that. We'll see more of that as we go along, but in order to appreciate what is Basel3, we need to understand what is the meaning of the term risk-weighted assets, as they call RWA. The regulation prescribes certain weightages to assets based on their risk category. For example, cash as an asset is risk-free, and therefore, the risk weight assigned to cash is normally 0%. And there are some asset categories like real estate, which are considered to be more risky than cash, so they might prescribe a higher percentage. So we have to know what is the risk rates that each asset class entails in order to understand the whole thing. Then we have a term called Tier 1 capital, which is the core capital for the bank, which normally includes the share capital and reserves, and these are pure money that belongs to the shareholders. But there is a very big list of what can also qualify as Tier 1 capital, as per what the guidelines that has been issued. And then we have this Tier 1 ratio, which is nothing but the core capital in relation to the risk-weighted assets. And another important term that we will use frequently during this presentation is the capital adequacy ratio, which is called CAR. It simply measures the bank capital as a percentage of risk-weighted assets to just see how well a bank is capitalized. This is the most important measure probably. And then we'll also use the term collateral, which is the asset that the borrower pledges when he gets a loan from a bank. Now, how did the Basel regulations evolve over a period of time? It started with Basel 1 in 1988, and it got enforced in 1992. And this was in response, all the three Basels are very interestingly in response to some crisis or other. So Basel 1 happened because of the messy liquidation of the Head Start Bank in 1973, And then Basel 2 was announced, the framework was announced in 2004, and it started getting implemented from 2008. And that was to basically standardize the regulations across the world. And Basel 3, which is what we are going to be discussing now, was basically announced in 2010 and 11 in response to the global financial crisis that erupted in 2008 but had its havoc in 2009. And by 2019, it is expected that almost all countries in the world will be Basel 3 compliant. And this is just a quick view of how things are shaping up from a Basel 3 point of view in the entire GCC region. As you can see that Kuwait has been very proactive when it comes to Basel 3. In fact, 2014 last year, they announced the implementation of Basel 3, and they have increased the capital adequacy ratio from 12% to 13% in 2 phases. And in 2015, they're aiming for 12.5, and 2016 for 13%. Different countries have different implementation schedule, but all of them are progressing towards implementing Basel 3. We must understand and appreciate that in the entire GCC region, banking constitutes a very important sector. The numbers that you have seen in the context of Kuwait, whether it is the financial intermediation or capital adequacy ratio or credit growth, all the metrics that comes with banking, in one form or other, you will see that happening in UAE, Saudi, Qatar, and all other places. Well, let's move into the core subject of Basel 3. There are 5 pillars to analyze Basel 3. The first pillar is to see what are the prescriptions from a quantity and quality of capital. Probably this is the most important part of the Basel 3. And then there are some leverage limits. We will see how Kuwait banking sector measures up to that. And we're going to be talking about the short-term liquidity for the banking sector and the long-term funding, which is important. And then finally we'll wrap it up with the risk management angle to the whole thing. From a quantity and quality of capital. Now, the whole idea of Basel 3 is to make the capital qualitatively very strong, so that when there is a crisis that comes next, the banks are in a good position to face them. So that's the whole idea behind Basel 3, is to make the balance sheets of banks crisis ready. So here comes the question of capital quality. So we are talking about a qualitative aspect to it, and that can also be addressed by the quantity of capital. So from a quantity perspective, you should be adequately capitalized, and from a quality perspective, the character of your capital should be robust enough to withstand any crisis that may come in the future. So what are the regulations that we are talking about from a capital ratios point of view? All my numbers are based on end of 2013. I wish I can use 2014, but it's too early, because the details about the numbers that I'm talking about comes along with the annual report. They don't come in terms of quarterly numbers. So this analysis is based on 2013 numbers. Now, as per the current CBK requirement for Tier 1 ratio is about 8%. But Kuwait banks in aggregate now is about 12%. But more importantly, we are talking about Basel 3 global norm, which is just 4.5%. And the CBK proposal under Basel 3 for capital adequacy ratio is 13%, and Kuwait currently enjoys 18.8%, which is close to 19%. So we have an advantage of close to 6% buffer, in terms of capital adequacy ratio. We'll see more of these numbers as we go down. I'm giving you the stat in terms of banks as you can see that there is a tier 1 ratio for all the banks, with the average being 17.4. Some banks have very big numbers and it affects the average. But more importantly, the capital adequacy ratio of 18.8% is again derived from all the numbers that we are talking about. But you can see here that the minimum at 15.4 is itself quite healthy when compared to the norm that we just saw. So across the board, we are seeing some good numbers to start with here. The second leg of Bازل3 is the leverage limit, and this is the Bازl3 stipulates that the leverage limit should be minimum 3%, and in the US, what they call it as the systematically important banks, they have prescribed 6%. That roughly, 3% translates into 33 times the lending, and 6% translates to about 17 times the lending. And Kuwait banks are now at about 8.7 times from a leverage limit point of view. So what does it mean? It simply means that we have huge leg room to lend. And we are at a very low threshold from a lending point of view at just about 8.7. As you know, banking business is all about lending. The more you lend, the more the profit that you make based on the margins that you have. And at 8.7 times the leverage ratio, we have a phenomenal room to move. Which means that as a sector, Kuwait banks, can marshal themselves to finance even big ticket projects, because they can move from 8.7 all the way to 16 or up to 33. So they have that leg room to maneuver. These are the current leverage ratios bank-wise. We said that for the industry's average is 8.7, and on top of the chart is Bulgan Bank at about 15 times, and Varga Bank at about 4.5 is on the lower threshold of the table. The third theme with the Bازl3 is about short-term liquidity and long-term funding. Bازl3 aims to increase the short-term liquidity and establish stable long-term funding. As you can see, that the core of the global financial crisis is basically an asset-liability mismatch, where short-term funds were used to finance long-term assets. And when it came up for rollover, people got into the asset liability mismatch problem. So we have to, by definition, banking sources of finance happens to be short term because it's predominantly deposit oriented, and the deposits can be time deposits or it can be demand deposits. But mostly in Kuwait, it's in favor of the demand deposits, which means the customers can come and demand their deposits anytime, so you don't know when they can come and call on their deposits. So the average maturity of deposits is going to be on the shorter side. There is no way you can change this structure unless you establish development banks with a long-term funding structure. However, if you see the lending habits of banks, just because their funding is short-term, it doesn't mean they can only lend short-term. They have to also lend long-term, and that's where they have to manage their assets and liabilities. This theme of Bازl3 is to make sure that the short-term liquidity is increased and the long-term funding is made more stable. As you can see now, liquid assets like cash or deposits with CBK roughly accounts for about 22.5% of the total banking assets. The customer deposits, as I just explained, is over 2/3 of the funding base. 40% of them are time deposits, and there is a deposit guarantee law that's been enacted in 2008, which is very common with many countries because it prevents a run on banks, and which also gives stability because the banking as a function is very core to the general population of the country. How is Kuwait ranks stacking up on the liquidity measure? As you can see, most of them have good cash buffers. It's awash with the liquidity, if I may say so. And short-term assets, as a percentage of total assets, is quite healthy across the board, but for some banks. So it's ample liquidity across the system. And the theme on risk management for Basel3 is basically to strengthen the alarm system if at all anything goes wrong, and basically reduce the interconnectivity among financial institutions so that there is no domino effect when things happen. This is constantly, there is a tool that they call as the stress test. So they stress test the banks theoretically every quarter, and they assume wild scenarios to exist, and they check how the banks stack up under such wild scenarios. And CBK comes up with stress test results for banks in Kuwait, and so far the banks have stood very well in terms of these stress tests. So as per the CBK report, even under the most stressful condition, the CAR, the capital adequacy ratio, is 11%, which is still extremely good when compared to the norm. So from a Tier 1 capital point of view, as against the Basel3 norm of 6%, the Kuwaiti norm is about 17.4, which is quite good. From a capital adequacy ratio point of view, against 10.5, it's 18.8, again good. From a leverage point of view, against 33 times, we are only 8.7, a lot of legroom to lend more. And the liquidity coverage ratio at, the Basel3 specifies it as more than 100%, but we don't see any stat on that as of now. As I have shown you in the first few slides, one of the important sectors that banks lend to happens to be real estate. So it may be useful to see real estate sector from the lens of Basel3, just as a case study. And this will enable us to understand the implications of Basel3 much better. Now, as you can see here, there are two aspects to real estate in Kuwait. One is real estate companies can borrow from banks to fund their projects, which is what is being shown in the lending profile of banks. And the second thing is real estate collaterals. People can pledge real estate as an asset, and they can borrow on the basis of the collaterals. Now, we have done some exercise here in terms of looking at the numbers very closely. As you can see here, there is this gross loans outstanding for Kuwait. This is the total loan that Kuwaiti banks lend to everyone. And we also have statistics about value of collaterals held, which is given up to 2013, and we have done our own projections up to 2018. But the most important part of Basel3 is that Basel3 stipulates that in a phased manner, real estate collateral should be de-recognized in the calculation of capital adequacy ratio. Now, what does it mean? It means that they are considering Basel3 looks at real estate as risky assets, and therefore they would like to phase out from a collateral point of view, not eliminate, but phase out so that it's not as big as it looks today. Now, there is no precise definition of what that phase out means, But today, real estate assets as a percentage of collateral is about 52% as of 2013. And even if you assume that 52% to reach, say, 40%, which is what technically phasing out means by 2018, we are still not seeing a very big impact, in terms of the overall structure. So there has been a lot of questions around this as to what will be the impact of this Basel3 provision on the real estate market for Kuwait. Now, as we see the numbers, I don't see a very big change, even if the 52% drops down to 40%. The real estate held as total collateral, which is showing the calculations here, will move down from 13.4 to 12.8. So we don't see a big difference, in terms of Basel3's specific impact on collaterals. But how about direct lending to real estate projects? Because you also have developers coming to banks and asking for loans for their real estate projects. And again, we have looked at the numbers, and we see that regardless, firstly, the real estate loans as a percentage of total loans is about 25% roughly. So it's about 1/4 of the total pie. And based on our calculation, we've taken 2010 as a very good year to explain what I am trying to say here. The incremental, for example, in 2010, if you look at F, that's the incremental real estate loan given by banks. It was just 0.1 billion, which is hardly anything. But if you see in the same year, the value of real estate deals is about 2.1 billion. So regardless of bank support to the real estate sector, the real estate deals keep happening, which means the real estate sector is not depending on banks alone for their funding requirements. They are probably tapping a variety of sources, including, say, for example, private equity, mezzanine financing, or real estate funds. We've seen a lot of investment companies launch real estate funds during the last few years. So the real estate sector is counting on diversified sources of funding rather than just looking at banks to support them. So, two aspects to real estate. One is the lending part of it, which we have made our calculations here, and we see that there is not much of a big impact on Basel3. And secondly, phased derecognition of collaterals. Again, the numbers show that it's not going to change the profile of the sector significantly because of Basel3. So, this is just one case study, because as you can see, a lending portfolio can comprise several sectors, including the real estate. Such an analysis can be made on non-banking financial institutions, it can be made on trade, it can be made on personal loans. So we can take up each category of the banking lending pie and see if Basel3 might help or hinder that particular sector. I have taken only real estate here because it's a very talked about sector in Kuwait, and many people are interested to know what would be Basel3's specific impact on Kuwait real estate. I also would like to run through very quickly a model case study. If at all you want to apply Basel3 on a particular bank, this is how it will flow. Remember, so far we have looked at it as an aggregate sector, but an aggregate is an aggregate, but individual banks can significantly differ, in terms of how they lend and how they operate. Some banks can have a large NBFC exposure, some banks can have very large real estate exposure, Islamic banks can have a very different asset liability structure. So it is important that we subject some sort of modeling to understand how a bank can flow through in terms of the Basel3 norms. As you can see here, as I explained in the beginning, we have something called as Tier 1 capital, and the tier 1 capital is comprised of A, paid up capital, B, reserves, C, retained earnings, and you have to reduce treasury shares, and we have assumed some arbitrary numbers here to show the calculation for how it flows. And then you have the tier 2 capital, and if you add tier 1 and tier 2, you have the total regulatory capital. And as I explained in the beginning, there is something called as risk-weighted assets. These are again divided into 3 categories, which is the credit risk, the market risk, and the operational risk. Assets are classified under these 3 categories to arrive at the total risk-weighted assets. You may have gross and you may have net here. Basically, the difference is the provisions that we are talking about. And once you have these numbers, then you calculate the tier 1 capital ratio, which is nothing but tier 1 capital by the total risk-weighted assets. And then you calculate capital adequacy ratio, which is nothing but total capital by risk-weighted assets. So this is how it flows, but you need to get into the annual report, the reporting structures to really go through this. Again, to study the liquidity ratio and leverage, we need to understand the cash that the banks carry in their balance sheet. You have balances with CBK, together it adds up to the cash equivalents, and then you have investments available for sale. It can be equity, it can be debt, it can be short-term assets, and then you have the total short-term assets. Then you have the total assets that is defined here, and you compute the total equity through a flow of capital, premium, reserves, and retained earnings, which we have seen in the tier 1 capital ratio as well. And then you compute the ratio as cash as a percentage of total assets, which is simple, and short-term assets as a percentage of total assets, and then you compute the leverage ratio, which is shown here through assumed numbers. When it comes to tier 1 capital, it's normally understood that tier 1 is always equities or equities in character, which can be retained earnings. But bonds can also come within the definition of tier 1 based on how it is defined in the regulations. For a bond to qualify within the tier 1, it should be perpetual bonds, and it should be callable bonds after a minimum period of 5 years, and you need to take the approval of CBK to exercise that call to call the bond. So under such a scenario, the bonds can qualify itself under tier 1. Bonds can also qualify under tier 2 if they have a minimum maturity of 5 years and callable at the initiative of the issuer. Now, why are we talking about bonds here? In times of the whole fundamental basis for Bازl3, as I explained, is to make banks' balance sheets robust enough to withstand crises that can come in the future. Now, when crisis comes, you have banks increasing their provisions, incurring losses, and they should be adequately capitalized. And when you have huge losses, you can do one of the two things. Either you can write off the loss if you have adequate reserves, or if you don't have, then you can convert some of your debt into equity. So this is where the context of bonds come in. They are very like a buffer. They can take the shock when it is really required. But there is another reason also as to why bonds make a very interesting study here. We can call them as Bازl3 compliant bonds, and there are several reasons as to why bonds make sense for banks, but two important reasons stand out. One is that the interest rates are very low, as you know, and it is easy to service bonds today rather than 5 years from today where interest rates are going to probably go up. And Kuwaiti banks are very low on debt equity ratio. As you can see here, most of them are either zero or very marginal. So there is a lot of room to raise bonds and buffer them into the debt of the debt equity ratio. So these two together makes a lot of sense from a Basel3 compliant bond programs for Kuwaiti banks even further to strengthen. Having said that, I must say that since Kuwait banks already enjoy a very big margin of safety from a capital adequacy ratio point of view, they are still not in a situation where they have to rush to the market in order to buffer up their capital. But however, for banks that decide to buffer up their capital, bonds may not be a bad idea as much as an equity is normally thought of as the major instrument to buffer up the capital. So, if I have to conclude, I would say that banks in Kuwait in general are very well capitalized, and the capital ratios at 13.3% and 18% capital adequacy is much better, providing excellent margin of cushion, and this is certainly higher than what CBK prescribes as of now. And the leverage limit at 8.7% provides excellent room to lend more and can even prepare banks to take on large ticket funding. And finally, I believe that bonds can be a very useful source of tier 1 and tier 2 capital given the low interest rates and the low debt equity ratio of Kuwaiti banks. So now I would welcome questions based on this.
Thank you, Mr. Raghou, for your thoughts. And